All right, let's get right into it. We're going to break down the story of a financial meltdown that absolutely blindsided millions of people. It's a crazy tale of high-stakes politics, total market chaos, and a financial tool that for over a century has been turning market dips into absolute disasters. So, picture this. It all kicks off on a Friday, January 31st, 2026. What started out as just another trading day, well, it quickly spiraled into a sudden, brutal crash in the gold and silver markets. And the shockwaves just kept rolling right into the next week. And just look at the scale of this drop. I mean, gold took a massive hit, down 17%, but silver, it was absolutely crushed, losing over a quarter of its value. 27% gone in just 2 trading days. So you have to ask, how on earth does something like this happen so fast? Well, you might be surprised to learn that the first tremor didn't come from a bank or some trading floor in New York. Nope. To really understand what happened here, we've got to look at a high-stakes political battle that was brewing down in Washington, D.C. The whole story really starts with this very public, very tense conflict between President Trump and the chairman of the Federal Reserve, Jerome Powell. This was a fundamental clash over which direction the U.S. economy should be heading. And this slide just lays out the core conflict perfectly. On one side, you have the president, who wanted cheaper money. He wanted to slash interest rates to fuel economic growth and, just as importantly, make it cheaper to pay the interest on that massive $36 trillion national debt. But on the other side, you had the Fed, terrified that cutting rates would just unleash the same kind of painful inflation we saw spike not too long ago. Okay, so then came the announcement that basically lit the fuse on this whole thing. Powell's term was ending, and President Trump named his pick to replace him, a guy named Kevin Warsh. And believe it or not, that single name was enough to change, well, everything. You see, the market was completely baffled by this choice. On one hand, Warsh had just recently been criticizing the Fed for keeping rates too high, saying exactly what Trump wanted to hear. But his entire professional history painted him as a hawk, someone who would almost always favor raising interest rates to fight inflation, not cutting them. It made no sense. And this just created this massive, paralyzing uncertainty. One minute, the market was almost positive that the next Fed chair would be a dove, someone who'd cut rates. The next minute, nobody had any idea what was going to happen. Was he a hawk? Was he a dove? The answer was, nobody knew. So in all that chaos, investors did what they always do. They panicked. They dumped assets like gold and ran for the perceived safety of the US dollar. But here's the crucial part. A simple shift in sentiment, a little bit of fear, that doesn't cause a 27% collapse. To understand that, we have to look at the hidden mechanism that turned what should have been a market dip into a total catastrophe. The key to this entire collapse, the real accelerant that fueled this fire, comes down to one single tool: financial leverage. It's the exact same mechanism that poured gasoline on the fire in the 1929 stock market crash and again in the 2008 financial crisis. So what is it? Think of it like this. You're investing with money you don't actually have. Your broker lends you a huge sum of money so that you can control a much, much larger position, all in the hopes of dramatically amplifying your profits. And you can see why it's so tempting, right? This is the dream scenario. A small 10% move up in the market doesn't just make you 10%. Because you borrowed all that money, you can pretty much double your own cash. It feels like you have a superpower. But, and this is the brutal reality, leverage is a wickedly sharp double-edged sword. That same 10% move, just in the other direction, doesn't just lose you a little money. It can completely annihilate your entire stake. Your 10 grand, poof, it's gone, instantly. And that nightmare scenario, well, that's exactly what played out on that Friday. When the price of gold and silver suddenly dropped because of all the confusion around Kevin Warsh, thousands of traders who were using leverage were instantly underwater. That 10% cushion they thought they had, it was wiped out in minutes. And this is what triggered the dreaded margin call. Phones started ringing, brokers were calling up their clients demanding more cash right now. But of course, most traders didn't have it. I mean, that's why they were borrowing in the first place. So the brokers had no choice. They had to start forced selling their clients' assets to cover their own loans. And right there, that's what created this vicious, self-perpetuating cycle. The first wave of forced selling pushed prices down even more. And those lower prices, they triggered even more margin calls, which of course led to more forced selling. At the same time, brokerages started getting nervous, so they raised their margin requirements mid-crash, forcing even more people to sell. It was a financial death spiral. So what's the real takeaway from all this? Who's the real villain? Was it Trump, Powell, the metals themselves? No. The true villain here was how people were trading.
You see, this whole crisis highlights a huge lesson that separates sound investing from just reckless gambling. What happened to all those traders? That wasn't investing. It was a high-stakes bet with borrowed money. And it's a bet that the world's most successful investors have been warning us about for decades.
Buffett's point here is so profound. You can have the most brilliant idea in the world, be the smartest person in the room, but the second you borrow money to make that bet, you introduce a risk of total ruin, a risk that can take you to zero no matter how smart you are.
And his longtime partner, the late Charlie Munger, he put it even more bluntly. He put leverage right up there with life's other most notorious and destructive temptations. That's how dangerous he believed it to be.
And that really brings us to the ultimate lesson from the Great Metals Meltdown. It's about asking yourself this very honest question. Are you truly investing for the long term based on the real value of an asset? Or are you just betting on price movements in a casino? A casino where the house can change the rules and wipe you out in an instant.